Hello everyone, what is up? My name is Reese, and today I will be getting into my first actual YouTube video for this channel, where the goals of this video is to kind of give a brief overview of what the stock market is, how it works, what kind of investment options you have within the market, and then things to take into account when you're calculating some long-term goals, longer short-term savings goals regardless of the time horizon, to see how realistic those goals are and things to take into account to see how much you actually need to save to reach those goals. So to start this off, I just want to say that I am testing out NVIDIA Broadcast to help eliminate both background noise as well as the background in my webcam. And I know right off the bat the webcam isn't going to be the best thing in the world since I don't have a green screen, but this is kind of just to hold me over for now to test out a new recording method using OBS. If this channel does do well, that's something I can look into, but this is kind of just a band-aid experiment for the time being. Without further ado, let's get into this video. So to start off, I'm going to go, and this is a presentation that I had made for my Google Drive video, or Google Drive link that I have created for some personal friends and family members to kind of just help share some education regarding the stock market and investment ideas. And so starting this off, we're going to dive a little bit about the stock market fundamentals, the three major indexes, your investment options within the market, and then a brief overview of how market cap sizes work, as well as value and growth stocks. And one thing to note, I do have my webcam over my monitor, so when I'm looking at my monitor to talk about things, eye contact will be kind of hard at the webcam, but just things that we're going to work with as a new YouTuber. So starting off, I'm going to talk about a brief overview of the Dow Jones Industrial Average. So what this is something that was founded in 1885 and is an index that currently tracks the 30 large market cap companies across various industries. And this includes energy giants like Chevron, McDonald's, Apple, Microsoft. These are kind of just your big name companies that are meant to showcase kind of the general overall market health of the US stock market. And this is something that is price weighted, meaning stocks that have a higher stock market price carry a higher overall weight in moving the average. And the Dow Jones has a historical importance. However, it's not as really relevant today. It is a general indicator of how the stock market's moving, and it's not something that people really buy a Dow Jones index fund to put their retirement money in. It's kind of just an overall indicator of, oh, the Dow Jones is up 500 points today or down 1,000 points. It's kind of just general sentiment, but it's good to know what it is, why it was founded, and what companies are in it. Moving forwards, we're going to get into a little bit about the Standard & Poor's S&P 500. And so what this is a composition of 500 large U.S. companies to represent the U.S. market strength. And the S&P 500 is split into 11 different market-weighted sectors, meaning stuff like technology, cyclical markets, defensive, healthcare, utilities, materials, energy, industrials, communication services, basically. And you can learn about this more in depth on your own. I'm not going to dive into it in this video, but companies are typically must be worth 14.6 billion or more to be included in this S&P 500. And this S&P 500 is market cap weighted, meaning the larger of a market cap a stock has. If you don't know what market cap is the number of shares outstanding multiplied by the share price to get the market cap. And the S&P 500 being market cap weighted means that the companies that have the largest market cap, such as Apple and Microsoft, will have the largest percentage allocation within the S&P 500. So as of right now, the S&P 500, this is as of 7/29. So the S&P 500 currently has a large tilt towards technology companies, Apple, Microsoft, Google, even Tesla made a recent big appearance due to their huge rally they've had within the past year. And because S&P 500 is market cap weighted, these companies are going to be what have the largest allocation of the S&P 500. Apple is 7.2% roughly. single-handedly. So these companies with large market caps are going to be really what are driving the market. Historically, the S&P 500 has had an annual return of about 10.5% since 1960. It is well diversified in practice because it includes both value and growth stocks as well as represents various industries. So let's say you invested only in growth stocks. Growth could be doing poorly while value stocks are doing well. So investing in the S&P 500 kind of gives you that exposure to both. And here's a sample of historical annual return since 1960. And since 1960s, there have only been 3 recorded years of an annual return of 20% or more. And it's not too hard to say that overall in the long term, the S&P 500 does go up. This replaces companies over time to help keep the index up, and is a general indicator of the overall market strength of the US stock market. And this is a very commonly invested in index. There's tons of low expense ratio index funds and mutual funds that can help you invest in this S&P 500. And moving on, we are going to be talking about the NASDAQ composite. So the NASDAQ composite is essentially just comprises of every stock that's listed on the NASDAQ. And stock tickers on the NASDAQ are typically tech companies, and they have 4 letters on average. So stuff like Apple, AAPL, Microsoft, MSFT. And then for example, if we're looking back on the New York Stock Exchange, which companies like T-Mobile and AT&T and Verizon are only going to have a couple of letters. So that's just kind of one thing to keep in mind. But NASDAQ composite is much more heavily technology weighted, 48%, for example. So these technology companies are really what drive the NASDAQ 100, for example, which is the most commonly traded index fund is QQQ. And so QQQ is heavily growth oriented, and it's kind of that high risk, high reward mindset. Now, keep in mind with investing with the NASDAQ and these tech companies is when you're investing in growth, you can have high periods of high rewards, but if you had invested in the peak of the dot-com bubble, for example, when the NASDAQ 100, it would have taken you almost 20 years to recover those losses. So one thing to notice is that the NASDAQ 100, typically the vast majority of the NASDAQ 100 is already in the S&P 500. So if you invest in the S&P 500, you are gaining exposure to these companies. This is the top holdings of QQQ. Top ones: Apple, Microsoft, Amazon, Tesla, Google, Nvidia, Facebook. All of those are in the S&P 500. So people who are investing in QQQ, for example, are really betting on companies like tech companies really performing in the long run, which they very well could. I'm not saying anything against them. There is just historically, it is more of a riskier composite to invest in. And so a brief overview of the difference between stocks and mutual funds and ETFs. So individual stocks are essentially, you are owning a small piece of a company, and these companies can either pay dividends, and it can most commonly refer to as a more riskier type of investment, because when you're investing in individual stock in itself, it is not necessarily diversified across an industry or market sector. Now, granted, you can invest in a very successful company over the long run and do just fine, but you can also be stuck holding bags because you invested in, hopefully you're not investing in a pump and dump or companies like, GameStop and AMC and Bed Bath & Beyond, which have been pumped up recently, where in the long run, those companies really might not be a good long-term hold. So when you're investing in individual stock companies, you really need to understand the fundamentals of the company. If they have what Warren Buffett refers to as a moat, meaning a tactical business advantage, a reason why that company should be doing better than others, and strong financial strength can really set you up for success in the long run. Now, an ETF, on the other hand, is typically traded as a composition of selected stocks that are usually a bit more diversified because they can include multiple stocks instead of just one company when you're investing in a singular stock. And usually they can track a certain index such as the S&P 500 or the QQQ tracking the NASDAQ 100, for example. And ETFs can be traded just like regular stocks on most brokerages. Typically will allow you to trade ETFs. And then mutual funds, on the other hand, are similar to ETFs but not as liquid. Instead of trading like a regular stock, they only price change once a day. So as an ETF, the price will fluctuate throughout the day depending on the demand, how the market's doing, whereas mutual funds will only trade once a day. Now, these are typically, fundamentally in the long run, they are essentially the same as an ETF. If you buy an S&P 500 ETF or mutual fund, in the long run, they should mimic each other performance-wise. But mutual funds it's more common for mutual funds to have a higher expense ratio, but also they are better suited for retirement accounts, because if you have a mutual fund in a personal brokerage account, they are not taxed the same, and typically you have to pay capital gains every year on a mutual fund, even if you're not selling it. So these are better suited for tax advantage retirement accounts, but it's good to know what it is. And ETFs and mutual funds, one thing to keep in mind is they typically have an expense ratio, or it's basically a percentage cost to own that mutual fund or ETF. It's like your buy-in fee. So one thing I really like is Vanguard funds, for example, because typically their expense ratios are under 0.1%, which can really save you money in the long run. You can have actively managed funds that have 1% versus 0.1% for a Vanguard fee, and that really can add up in the long run. Now we're going to talk a little bit about the different stock market categories. So market cap is a big thing to take into account for when you're looking at a company. Is this a small, mid, large, or mega cap company? So mega caps are going to be companies that are worth more than 200 billion market cap wise. Things like Apple, Tesla, Amazon, the big, huge companies that really are driving the market and are big name household names. And then small and mid cap are typically companies that are potentially either growing or just smaller companies overall. And so investing in these small companies can potentially set you up for growth in the future, but you have to keep in mind typically these smaller companies may not be as developed and have what I referred to as a moat earlier, where they have a strong competitor advantage. Because if they really were an established strong company, typically those are already in the S&P 500, which you pay a premium for in terms of price per earnings ratios. So small and mid cap companies typically have lower price to earnings ratios on average, so they can potentially set you up for longer growth. Now, I will get into price per earnings ratios and all those fundamentals in another video, but keep in mind, I'm just talking about how the market is split. And then the S&P 500 is split up into 11 sectors, which, like I said, I won't be getting into in this video, but if you want to look into it in your own, this can really help you better understand how the market works. And then another thing to take into account, your investment style. Are you more of a value blended investor or a growth oriented investor? So this is a Morningstar grid. Morningstar helps you, these grids really help you know what you're investing in and what it really looks like. So this grid is typically set up in a 3x3 fashion, where you have the investment style, value, blend, and growth, and market cap size, small, medium, and large. And so typically the smaller cap you are moving into, the higher the risk. So small caps are typically higher risk than large cap. Not always the case. There have been and are very strong small and mid cap companies that are performing better than the large cap competitors. However, you have to usually have to dig a little bit more. Usually these names might not be as common. And then growth-oriented stocks are more focused on expanding their company versus a value-based stock typically has a more developed financial system. And so now going into a little bit about market cap performance, this is a comparison from the year 2001 to as of, I believe this was charted in late July of 2022. And so this has changed slightly since then. But over the long run, this is a comparison between the S&P 500 versus the small and mid-cap counterparts of the S&P. So the S&P 400 is a composition of 400 mid-cap stocks that are not included in the S&P 500, and then the S&P 600 is a composition of 600 small-cap companies that are meant to represent the extended market caps that are not represented. So in the long run, as you can see, there has been periods where the S&P 500 has outperformed these smaller caps, but in the long run, if you had invested in 2001, you would have gained quite a bit more in returns if you had invested in small and mid caps. Now, with that being said, I'm not saying invest 100% in these small companies, because these companies tend to drop significantly more in times of economic uncertainty, because they may not have as developed of a financial system as a larger company. Now, this is not always the case, but keep in mind these are a little bit more volatile and a little bit more risky. However, you have the potential for long-term premium. And then I'm talking a little bit about value and growth stocks now. So growth stocks are essentially considered to be a little bit more aggressive and volatile in hopes of investing in a rapidly growing company. Typically, they'll pay lower or no dividends, and a lot of these growth are based on future growth estimates. Hence, they are typically overvalued in nature by higher price to earnings ratios. But if the company continues to grow and do well, you can be well rewarded with capital gains. And now value stocks are typically considered to be undervalued when comparing current fundamentals to their stock market price. And the idea is, when you're investing in these value-based companies, is that maybe that particular sector is doing poorly at the moment, but these companies are doing well and they have strong financials. So ideally, these value companies can help you maintain kind of a long-term stable portfolio, and they usually might pay a higher dividend yield than a growth stock, for example. I'm going to turn my fan on real quick. It's a little hot. Probably a little funky for those watching. But essentially, the idea of growth stocks versus value is, what are the current financial state of the company? Even Apple is considered a value-based company, because the last I checked, they had over $300 billion in cash, which is ridiculous. That is a lot of money. And so value companies are going to be companies with strong financials, and then a growth company is company that is focused on growing, reinvesting their profits, and expanding their market reach. So historically, value stocks in the long run have outperformed growth stocks. However, recent bull markets, such as the tech market boom in the late 1990s, as well as the bull market that we've seen since the financial housing market crash, tech has really done well. They have exploded, and essentially Apple, Microsoft, Google, Facebook have really expanded their reach in terms of their consumer base, and now they have built basically empires. And so those individual companies have really been the driving force of the S&P 500 in recent years. And so we could potentially be set for a rotation to more value-based companies now that interest rates are rising. Now, I'm not saying sell all your growth stocks and buy value right now. I'm simply saying these are things that you maybe should look into on your own to see what you're comfortable investing. If you're already holding these tech companies and you want to hold it for 10, 20 years, by all means, I think that could be a great idea. It's all comes down to what people are comfortable with and what meets their needs. And then don't forget dividend stocks. So dividend stocks are companies that are regularly paying out a portion of their profits to their shareholders. Because remember, when you're buying a stock, you're not just buying a piece of paper that says, I'm a stockholder. You are actually buying a percentage of that company, and you could potentially be entitled to those dividends. And when you're buying a stock, you have to remember that you're not just, trading electronic stuff. When you're actually owning a company, you have to really take into account, is that stock something that you are willing to actually be an owner of? Now, granted, you're not having to, necessarily spend your time managing Google, for example, just because you bought Google stock. But really, when you're buying an individual company, make sure you understand what the company does and what their long-term goals are. Because when you're buying into these companies for the long run, you're becoming a part-time owner, in theory. So you got to make sure that this is a company you are willing to shovel money out of your pocket and put your money in and ride through the downturns and the upturns. And so dividend stocks are a way for you to receive a kind of a passive income, because you're going to get higher returns with a dividend stock yield wise versus, tech companies. And so usually, depending on the economic strength of the individual company, they could be potentially more stable in the long run and not as fluctuate as much during economic downturns, such as the housing market crash or even the crash we have right now. This year-to-date, value stocks and dividend companies have performed better on average than big tech names. And so dividend ETFs can help you diversify with potentially less overall risk in the stock market while allowing compound appreciation. One thing to think about, though, with dividend stocks is there's two types, really. You can have companies that are focused on long-term dividend growth and companies that are focused on paying a high dividend yield. They are not the same. And companies that have a strong yield and growing yield, now those are special. And so I will definitely be making a video about the types of dividend growth versus high dividend yield, but these things just think in mind. And so that was a brief presentation of the overall stock market, and this is something that I created for those viewers. So thank you guys for watching. I will be uploading another video soon of getting into part 2 of this video, because I don't want to have an hour-long video. But part 2 will be more directed towards savings goals, how compound investing comes into play, and what you need to take into account for how much you have to actually save to reach those goals. So thank you for watching, guys. I hope you guys enjoyed this video, found it informative. As I get better at these videos and do more, I should hopefully get more comfortable with just an overall smooth experience. So bear with me, please. And once again, if you have any feedback or any recommendations of suggestions of what you'd like to see, feel free to comment below. I'd be more than happy to take a look and get back with you if that looks like something I could do. And as always, hope you guys have a great day. Thank you for watching. If you enjoyed this video, please leave a like. Thanks for watching, guys. Bye.